Welcome to Financial Fortitude, where knowledge meets power and purpose. I am your host, Carolyn Cox, proud member of the Rutherford County Alumni Chapter of Delta Sigma Theta Sorority Incorporated, bringing you real talk on all things financial, from budgeting to building wealth and everything in between. Whether you're getting started or leveling up, you're in the right place. So grab your notepad and get ready to secure the bag. And don't forget, like, share, subscribe so you never miss an episode. Let's grow, glow, and get financially fortified together. I am so excited today to bring you my host. Or my guest today is going to be Brian Roberson. And I am so excited to have him. He's a mortgage officer. I'm going to give him an opportunity to introduce himself, tell you a little bit about what it is that he do, because on our last episode, we were talking about home ownership. And, everybody wants that dream home, that starter home, that investment piece. But sometimes you really kind of need to know how to get started. What do you need? How do you really prepare for whatever that investment is? Brian's here to talk about it. So, Brian, introduce yourself and tell
Hello.
the people who you are.
Okay. Hello, my name is Brian Roberson. I have been in the mortgage industry since 1998. Been in banking since 1996. So as you can see, my whole entire adult life, I've been helping people purchase homes. My job at the bank is to uh, get people into houses by going through the programs and whatnot. I'm not the underwriter, but I help facilitate that for you.
Okay, so now when you say you're not the underwriter specifically, and you mentioned a couple of things, you said programs, which we definitely like to take a deeper dive into that. And you said you're not the underwriter, but you help people get ready. What is that? What are some of the programs that we can actually use, and how do you prepare them to be ready to
Okay.
get to that underwriting process?
Okay. Okay. Definitely. What you have when someone comes to us as far as to look to purchase a home, uh, the bank, the person at the bank that evaluates that risk is called an underwriter. The loan officer prepares your file to submit to an underwriter to evaluate you. The underwriter does not know you from anybody other than just what is presented. And so they're looking at four things. They're looking at your credit. They're looking at your capacity. They're looking at your capital. And they're also looking at the collateral. So those are the four categories that they evaluate when they determine whether they should lend you this money. And so the number one, as you saw, was credit. The things that they evaluate on your credit is, are there any late payments? Are there any judgments? Are there any collections? Have you ever filed bankruptcy? Have you ever had a foreclosure? If you've had a number of those things, it's not the kiss of death, I tell people. Sometimes those are just hurdles we have to jump over. For example, if you have a late payment in the last 12 months, we obviously want you to keep paying on time to improve your scores. Typically, after the 12-month mark, the points start coming back. Next example would be a bankruptcy. There are minimum waiting periods per guidelines for different programs. Like a conventional loan is 4 years. On a FHA loan, sorry about that. On an FHA loan, you're looking at a 2-year waiting period if you've had a bankruptcy. If you've had a foreclosure, the waiting period on an FHA loan would be 4 years. On a conventional loan is 7 years. So those are minimum standards you have to meet. And also during that time period, you need to have reclaimed credit standards as far as being able to pay things on time, not getting new collections or judgments and that sort of thing. So those are the things that they kind of evaluate when they're looking at credit. Then the next category jumps into capacity. And the capacity we're talking about is, do you make enough money to afford the house that you want? Sometimes you can't afford that dream home, that very first home. So sometimes you have to build upon that. So I try to tell my customers that are first-time home buyers, don't try to max your debts out to try to get the max from the very dream home on your first house. Get a house that you can make payments on, enjoy living. Especially if you're young, you're going to want to do things like go to the mall, buy clothes. You're going to go to the movies. You want to go to clubs and do certain things to enjoy life. You don't want to be what we call house poor. Because typically when you make house poor, you make bad decisions on whether to pay the mortgage or go out. Well, young people, as we all know, they're going to go out.
Right.
So mortgage payment is on the back burner, or what they're going to do is say, Mama Carolyn, can you help us this month? When
Right.
That type of deal. We don't want you set you up in that space. We want you to enjoy what you can do and live your life, but still create wealth by building your portfolio of properties.
Okay. Well, you said you said a whole
It's a
mouthful.
mouthful.
Ooh, let me make sure I write some notes down. So let's start with that first piece. When you talk about credit, one of the things that I have often seen is, let's just say I'm new to the game. I just got out of college. I've got a credit card or two, but nothing specific. And so many times I hear people say, well, my credit score just doesn't move. When you're looking at a credit score, what does that compromise, and what, or encompass, and how can an individual who's trying to raise their credit score do a better job when it comes to things like credit utilization, the type of credit that they have? If I'm new to the game, and I'm fresh out of college, I got a decent job, but my credit score is sitting in the low 600s. Now, if I'm not mistaken, I can purchase a home if all of those other things kind of go together. But what can I do as as an individual, period, to actually raise the credit scores that I have and keep them from being stagnant?
Okay. The things you're going to want to do is typically most kids coming out of college, if they've had one or two credit cards, they either paid late or they've maxed it out. You want to use your utilization down to about a third of the limit or of the cap in order to see your scores starting to move and increase. Obviously, paying the payment on time, paying a little more than the minimum payment. Those things will help move that needle. And don't close out your credit card. So a lot of people say, okay, I had 3 or 4 credit cards. I only used one, so I closed the other 2. Never close out old credit cards, even if you don't have a balance on them, because that history of having those long-standing debts of credit cards looks good. And so it actually improves your credit score by having old credit cards. Now they need to be open. Obviously, when they're closed, then that stops making the needle move. So those are things as far as when you do have credit. Obviously, if you have student loans, those are going to impact your credit as well. So stay on top of those. If you have a deferment, make sure that happens. A lot of people take it for granted that things get reported. It is our responsibility as the consumer, which is sad, to control what's on your credit report. Meaning, if there are mistakes, it is your responsibility to get them fixed.
So how often, I'm new to the game. How often should I actually look at a credit report? I mean, if I'm paying my bills on time, why do I need to look at it? And what does that do for me?
Well, you need to go at least once a year to get your free credit report. You can go to each three credit bureaus and ask for a request of a copy of your credit report, and it's free. Just so you want to take a look at it. Like I said before, a lot of times things get reported that are not updated, that could be erroneous. It may not even be you, and you don't have a clue because you're like, I pay all my bills on time. Well, they may have put somebody else's credit card on your account, or as far as on your credit report, and therefore it's hindering your scores. So you should always look at it every year and scrutinize it. See if things are being reported correctly, because sometimes even your bank that you have a credit card with may not be reporting the information correctly. So it is, like I said, it is your responsibility, which is sad that that is kind of pushed down on. It seemed like it seemed like it would be reversed, that they would be held to a higher standard on making sure the information is correct. And so in this new climate, they are really deregulating certain industries that protect consumers, and that's part of it as well, that they're not going to be protecting you like they should. So you need to be on the lookout for things that are happening on your credit report.
Okay, so let me ask you this. I know that there are three credit reporting agencies. Why do the numbers fluctuate the way that they do? And can you tell our listening audience what those three are and why they may look differently at certain points in time?
Yeah, well, we have Equifax, TransUnion, and Experian are the three major credit bureaus that all lending institutions use to evaluate someone's credit. Those three institutions, proprietary, they don't give us as lenders what exactly makes their number different from the other. But what they're going to do is they're going to look at your history as far as how much debt you have, how are you maxed out, do you have collections, whether they're medical, or do you have judgments, do you have tax liens, all those things. They kind of put it in their little model. And they're not going to tell all of us consumers how they create their score, because they want to say ours is better than the other. So they don't want anybody else to kind of get. But I'm so sorry that this thing did not turn off. So they're looking at, as far as, they won't share that information with us, but would they kind of tell you what impacts your scores? And that's what we kind of tell customers, keeping the balances down, pay off any recent collections, and keep paying on time. If you've had some lates, make sure you catch up by, make sure the past due is gone, make sure you keep paying. Those are the type of things that impact you. Pay the balances down, like I said. So that's what they kind of give us as lenders or anybody that deals with credit, to kind of say those are things that impact. But they won't say, okay, if you pay this down, your balance to a third, I'm going to give you 50 points back. No, they don't tell us that. They just tell us that it can, when we run through some analysis, what can it increase those scores, but they won't say do this and it'll give you 5 points. Do this, and they won't do that.
Gotcha. So now, how often? How long does it typically take? Let's just say I've got a judgment, or write-off, a tax lien, or something like that. How long does it take someone to actually see progress or have I know that, I think, if I'm not mistaken, it's 7 years as far as derogatory things are concerned.
That's correct.
But
it's 7 years when it comes to that.
But let's just say, I'm actually paying my bills on time. And I start to make some of those adjustments or what have you. Am I going to have to wait 7 years if let's say I've got a judgment, am I going to have to wait 7 years before I see an increase, or will it start to slowly increase over time after I've paid that judgment off?
It will slowly start to increase monthly. As long as that judgment is still outstanding, that's going to still hurt you. So the suggestion that I make, if you do have a judgment, is make a settlement offer, so you can get that down to where it's paid in full, or paid at, or settled for less. Then that also improves by you paying everything else on time. It allows that to speed up the process. But if you just leave that out there, then that's going to hinder you for 7 years. And so it's not going to move. Your score is going to going to move at a slower pace. So you want to try to settle those big judgments to get those where they are, stop hitting you so hard. And over time, those are going to, as you get closer to the 7 year mark, before it starts to drop off. It's 10 years if you have a bankruptcy and foreclosure, that's going to stay on there. But you want to aggressively attack any of those judgments that you have in order for that to hit zero, so that doesn't hit you quite. It's still going to hurt you, but that percentage goes down throughout that until it drops off.
Okay. So when we talk about things of that nature. One of the things that I've heard, and you're going to have to help me out and let me know if it's true. I've heard that you can send a letter to your creditor and say, I will pay this in full if you will remove it. How do those kinds of things actually happen if you're communicating with that creditor to try to get that negative thing off your credit report?
Yes, it does. I mean, it's just about how willing their ability to do it. You know, a lot of times they may not be willing to do it, but I always tell my customers to ask. I even tell customers to ask about a late payment. You know, what I mean, you got to ask. If the only thing they can tell you is no, and if they
Right.
tell you no, then we know just got to keep time. Is going to improve your credit score. It's not gonna. They're not gonna be mean to you, yell at you, cuss you. It's as a consumer, you have the right to ask, and if they're willing to do it, great. So I ask everybody to speak to a supervisor. Always, if you're going to call on phone, don't talk to the first person. Well, I mean, be nice and pleasant, but say, hey, I would like to speak to a supervisor, because those are the people that can make those decisions. The front line person is already given a script on just to collect the money and try to get it all, and then they don't care about negotiations. They don't care about taking it off. Well, if you kind of appeal to someone's heart and say, hey, I am trying to purchase a home. I'm trying to rebuild my credit and be more responsible. If I could pay this debt off, would you be willing to remove it from my credit report? And if they are, great. So that is a possibility. It's just like I said in the beginning, you have to do the work. You have these companies out here saying we can fix your credit, but they charge you a fee. Why not do it yourself? If you really want something bad enough, you will take the time to do it yourself. And it's free to you, but it's going to cost you a lot of money, which you may not have, and to put you more behind the eight ball on saving money or doing certain things by you paying somebody else to do your legwork. You can do the same thing. Just pick up the phone and call.
Okay, so now speaking of these credit fix people, now I've heard lots of horror stories, and I've honestly I've not heard anything positive. One of the things that I've heard is that they will, they'll negotiate a settlement or a payment or what have you, but what happens is those cards are closed. They may or may not be paying them in a timely kind of fashion, and you put yourself more in a trick bag of this is going to take forever, versus, I like the snowball method because I like to see when stuff gets done. I'd be like, let me just check
That's
this
right.
on off.
That's right.
But,
That's right.
are there truly reputable credit folk out there? And if so, do you know any that if our audience said, I just can't do this by myself, I need some help, where would they turn to get that assistance?
I would say you could go to your local housing agencies. They have relationships with these credit agencies that can help you. They have credit counselors that can kind of take you down that path. I think those are the ones that you go to versus those people that say, hey, send me $600 and I'll fix your credit. Those are not the people that fix your credit. They're in the business of the money. But there are organizations that you can go to. Obviously, I don't have them in handy. And obviously, if we do this again, I can have that prepared. But there are agencies, like if you go through THDA's website, there are counseling agencies that can assist you on their website. They have a list there that you can kind of go through, and they can kind of help you navigate that. Obviously, if you go through me as a lender, I kind of give you the blueprint. You have to follow those blueprints. I can't do it for you, but I will give you the roadmap to do it, but you got to be willing to do it.
Okay. So now what if, and look, I have done it on occasion. I paid off a credit card and I was so excited. I was like, I'm done. And I even cut it up because I was like, I'm going to keep it open. It's got a nice little credit balance. But I really, I was like, I really don't want to use this card. Cut the card up. And, now folk don't send you stuff through the mail anymore. We have opted to do everything online. And so what had happened was I actually had put an auto pay something, I think it was like Ring Central. It's $35 a year, but I used it, didn't get a bill for it, Couple days later, they calling me up. Not only do I owe them $35, I owe them a late fee and I owe them
Yes.
interest, which I absolutely detest. Now,
Yep.
9 times out of 10, they're gonna show up on my credit report at some particular point in time. How is it,
Yes.
how negatively does that actually affect you? And as a consumer, because even when the woman called me, I was like, lady, I don't know you. I ain't used this card. I mean, I didn't get ugly
Yeah.
because sometimes
Yeah.
we be acting kind of
Yeah.
funny.
Yeah. Yeah.
But I
Yeah.
was like,
Yeah.
when she mentioned it, I was like, you are so right. Yes,
Yeah.
I did.
Yeah.
So
Yeah.
for a $35 purchase, I ended up having to pay them $80 because I really, it is a card that there are cards that I do like to not have a balance on. And
Yeah.
so
Yeah.
it's like, woo, and then I know come, a month from now, I'm going to be looking at some ticks on my credit report because I didn't make that payment on time. How do you fix that when you honestly make a mistake and say, oops, I forgot?
That's what you ask that creditor. Say, hey, I totally forgot.
Yeah.
Is there a way if I pay this immediately, can you remove the late payment? They have the right to say no, obviously,
Hmm.
but I would ask. I really would. It's not a way for us to fix that because it is true. It's not erroneous. It is a true statement. You did not make that payment.
Right.
So, but it's if you can plead to their hearts and say, hey, that's totally, as you can see my payment history with you, I pay on time, I paid it all. Is there a way you can work with me? I just was not, I did not remember that. So that's the
Hmm.
way to fix it. Other than that, it's just time is going to improve the credit score. My only tip to fix that problem with the consumer, which I do myself, and which I told my kids to do, I gave them a ledger book. Write down
Hmm.
every credit card, every bill, everything, auto pay, everything as it goes through the month.
Yeah.
I don't care. Every month I do that. I'll go through, even if I don't have a bill, I'll write zero on that one. I go down to the next one, write in the ledger what I paid on that credit card or paid on this. Then to go check those things to sit there and say, okay, yeah, I do have an auto thing. Or write it
Hmm.
in the ledger. At that month, this is going to come out. You have to do a manual. That's me. I'm a manual person. So I'm a 70s baby. So I write stuff down versus the computer. So I think that's the way to make sure to stop that pitfall from happening. But once
Hmm.
it's happened, you got to appeal to their hearts, like we said, or it's just going to take some time. And it may be a couple of months, pay everything on time, and it'll start bouncing back.
Hmm.
After it gets past a couple of years, then the sting is not quite there anymore.
Okay.
But anything within the first 12 months, it's a little sting. After that, it progressively goes down. And after 2 years, it's really a small sting.
Yeah. Now look, it's really interesting that you talk about being a 70s baby. We ain't gonna talk about how old I am. Uh, but I'm gonna tell you the very first time that my husband and I actually were like, we really want to get serious about this credit thing and just paying stuff off. I'm gonna tell you, I love Excel. So I did exactly what you did. I put that stuff in an Excel program because back then they ain't have all this fancy stuff they got now,
Yeah.
right?
Yeah.
And
Yeah.
so I put it all on an Excel program. I listed it smallest to largest. This is what we're gonna pay a month. And I even kind of wrote it out. We had a 2-year plan.
Mm-hmm.
And every time we pay something off, it was like we was checking it off. And I put it on the refrigerator because I wanted him to actually see exactly
Yeah.
what we were
Yeah.
doing, and because
Yeah.
I wanted him on board with the plan.
That's right.
Now, you know, everybody ain't, I still like it that way. I still use an Excel spreadsheet. But one of the things that I know that there's so many different programs and things out there like that. For those of us who are more tech savvy,
That's
are
right. That's right.
are there any online programs or anything that you would recommend to a client to say use this and let's help with the budget and the paying off and all that kind of thing?
I think one of the biggest tools out there is going to be QuickBooks because it'll work. It can work directly with your bank account, and so it can, everything that comes through, you can kind of do a spreadsheet. And I don't use it. I know several people that do. My
Mhm.
fraternity, as you can see, I'm wearing my lapel pin.
Okay.
We use QuickBooks on all the way from our national headquarters all the way down to the chapters, and so it does allow you to be able to run reports, be able to see what's going out the door, what's coming in. So that allows you to easily budget on things. So I think that was one of the major ones out there. There's several. I would suggest Googling and then read the reviews. I mean, obviously, but QuickBooks, a lot of times it will work, right with your, sometimes they'll even offer it with your bank.
Oh, okay.
So that may be some of the cash services that the banks may use for you. So I've seen that before. I'm not going to pub another bank name, but so that is an option there. It really is. But I would Google, but QuickBooks is going to be a good tool you can use as well.
Okay, so now let me ask you this: as when we're talking about credit and debt management, I know that, when you have a mortgage or a car loan, there are lots of different kinds of debts that are out there that correlate with the credit score. So let's just say, I've been going through some tough times and I had to go to one of those folks that's sitting on the corner that says, we'll give you $1,000 and you got to pay me back 1,500.
Mm-hmm.
They are out there.
They are legal loan sharking.
Yeah. So when you look at that debt mixture, what does a good ratio truly look like, and how does those kinds of lenders, how do they affect your credit score, or do they?
Well, they do affect your credit score because of they're a little more riskier loans. And so sometimes that is a clue that you're running through financial strain. If you have a lot of these cash check placing loans that hit on your credit report, so that is an indicator. They don't give us the number of points that it affects. I would say try to stay away from those if you can, because that, like I said, those are legal loan shark type deals. I mean, try to budget, try to save, try to do best you can. But you don't want to be heavy on credit card debts. You know how if you go into the department store, I'll give you 25% off.
Yes.
I mean, they hit us every time we go to TJ Maxx or any of those places. Hey, you need to get 10%, 20%. It's not worth it opening up those accounts. It really is. That little 10%, 25%, whatever they're going to give you, having all those credit cards, even if you don't have a balance on it, does look like, okay, this person has a possibility of running everything up and just blowing up, their credit, being able to afford anything. So that does hurt your scores, having tons of revolving debt. So I always tell customers, try to only have one major credit card, maybe one other. Have one that you kind of use on a daily basis, and another one is just for emergencies. So if you can keep it to two, that's great. And then you can have installment debt. Installment debt is considered good debt because you're making a fixed payment and that debt's going to go away. And so if you have a couple of car loans, I think that's fine. If not even three, it's fine. Those things don't tend to hurt you quite as bad as having 6 to 10 credit cards. And you wouldn't believe how many times we put in this. I mean, they have every last store that's in Middle Tennessee. They got a credit card. And they usually have little small balances. They're $500 limits, but they owe $500 almost to the max on every last one of them. Right. And so they sucker you in to get that discount because they know that's to make you charge more. And most people, when you charge more, you're not going to pay that off at the end of the month. Most people are not like you, Carolyn, that are really willing to say, okay, whatever I charge, I'm going to pay off monthly. That's the best way to use credit cards. Really, it is when you get your paycheck and pay it all the way off. That is the best way to handle credit cards and don't pay interest. But for the masses, that's not realistic. So use the credit card responsibly. Don't use it to go buy clothes that you don't need. If you buy necessities with credit cards, not your wants. So that's the key: is you buy necessities and your wants. I've told that to my kids. If you can't pay it off monthly, don't do it. I had, when I was young with the kids, we had to use credit cards to survive. And so I knew going in, when I taught my kids, I said, look, don't go down that road. Don't get that credit card. If you have one, just use it to catch a flight home. Or if you have a flat tire, that's what you use your credit card for. On your needs, not your wants. Everybody's going to want something.
Oh, yeah.
You can't afford that Louis Vuitton bag or those red bottom shoes if you got to charge it and you can't pay it off monthly. You got to be realistic with yourself. If you want to be financial, secure debt manage, control your debts. Don't put wants on credit.
Oh yeah. Look, I love that. And I hope that everybody is actually listening to that because and it's hard. You really it's almost like diet and exercise. You gotta be disciplined.
That's right. That's right. Exactly.
And so many times that is the hardest hurdle. But one of the things that I learned was that once I actually started to pay off credit cards and when I said I want to go here, I want to go there, and I actually budgeted for it. If I know I've got 6 months in advance, I can save a couple dollars to go and do what I need to do. And
Hmm.
it is
Hmm.
exciting to be able to come back and not have that additional debt that goes along with having a good time. You know what
That's
I
right.
mean?
Exactly. Exactly.
So now let me ask you this, because you said a couple of things. Talk to me or talk to us about the various programs that are out there that will assist us in this whole home buying purchase. Can you speak on some of what those are and what the qualifications are?
Okay. Several banks, and as far as my bank, First Bank, we do have first-time home buyer programs where we assist you with your down payment. We have several that either give you a grant uh, where you don't have to make payments on it, and then we have some that we give you just straight 100% financing, whether it's a first mortgage and a second mortgage, to allow you to be able to not have a down payment. Those programs do allow for the seller to pay your closing costs if you negotiate for that. So I
Mm,
always say that you can get into a house for about $500 to $1,000 if you can negotiate when you put an offer in on a house for the seller to pay closing costs. If you qualify for one of the programs where we're giving you the down payment, so you don't have to save 20%. Those people still think I got to save a bunch of money. You do not. I still say if you only have $500 to $1,000, you still need to wait because when you buy that house, you got maintenance. You can't
yeah,
call anybody to go fix the water heater or do the things that you want. That's on you. When you're renting, you just call the landlord. So you
right.
still need to save some money before. So even though we're saying we're going to give you the house with zero down, seller's going to pay all the closing costs. You're only going to put going to put $500 to $1,000 down. I still say if that's only the money that you have, please wait till you save up just a couple more months to save up something because you're going to need a rainy day fund.
Hmm.
Houses are upkeep is not like renting.
Right.
So like I said, just kind of jumping into that. But there are programs that we can assist you with. Whether, like I said, whether it's a grant where you just get a lump sum that you can use it any way you want to, whether toward the down payment or toward closing costs, or you can get 100% financing. So we have several programs, whether they're conventional loans all the way up to FHA loans. And if you're a veteran, you also get 100% financing through a VA loan. So we have several walks of life that we can help you with that.
Okay, now look, we talked about those three different types of loans on our last episode, but since we got some folk here that maybe didn't get the memo on that, can you tell us the difference between a conventional loan, an FHA, and a VA loan?
Okay. On the VA loan, let's start with the easiest one. The VA loan, the only way you can qualify for a VA loan is if you are a veteran. If you're discharged, you have to be honorable discharged. If you're still in the military, you still would have to be able, you still would have a DD 214 and be able to get a certificate of eligibility to be able to say you are eligible for that. So that's just the easy one to kind of get out of the way because if you're not a veteran, you don't even have an opportunity to take advantage of that. So the
Right.
next one, and it is backed by the federal government.
Okay.
It's backed by HUD, Department of Housing. The same thing as far as FHA, that one is backed up by the federal government, the Department of Housing. And so that program they created back in the 70s to help people that have lower credit scores, may need down payment assistance. So they're a little more lenient on credit issues, like we talked about before about the bankruptcy having a shorter term, foreclosure have a shorter waiting period. So they created that program to try to really help people that may need some help getting a house. So that
Mhm.
program, typically on an FHA loan, you have to put 3.5% down, uh, but you can get down payment assistance from several different organizations that can help you do that. So that's the way traditionally FHA was built on trying to help people. They either had credit issues or don't have enough. assets to get a house. They don't have 20% down. That's what it really boiled down to. Conventional,
Okay.
when it started out, you had to have 20% down because they didn't have what they call mortgage insurance. So now let's jump into conventional, the third category. On conventional, you have two major companies that back conventional loans. It's Fannie Mae and Freddie Mac. They set the guidelines on those two. They set their guidelines on conventional loans. And so all the lenders, we kind of follow suit, follow their guidelines on originating those loans. Typically on a conventional loan, you got to have a higher credit score. Typically you're going to be 640 above in order to do that. On FHA, we can actually do 580, 585. But so like I said before, on FHA, it's geared toward have a lower credit score and be able to still get your house. On conventional, going back into that, used to have to put 20% down. Now, companies have come out there named mortgage insurance companies have come in and said, okay, banks will insure in order so the buyers don't have to put the full 20% down. We will assess a mortgage insurance payment and allow them to be able to now go up to 95% or 97% on a conventional loan. So things have conventional has kind of stepped their game up to kind of compete a little bit with FHA over the years on being more community driven, being able to get those lower down payments. And it all boils down because these mortgage insurance companies said, hey, we'll insure a percentage of the loan. So banks don't worry about it. And so that's when banks said, okay, conventional, we'll be able to extend those out. They have tighter guidelines than FHA. They're going to require longer term periods as far as if you've had some blemishes on your credit. So typically they're going to be more stringent. All of those programs run through, whenever we evaluate you, we run them through what they call an automated underwriting system. Those systems evaluate your credit, like I talk about, your capacity, your the collateral, and the capital. Those things are the four categories. They kind of evaluate on all those programs. And like I said, FHA, they say, okay, the tolerance there is a little lower, so they allow you to do a little more when you may have some blemishes. VA is the same way as FHA, but that's the difference between those programs. I hope I answered it effectively for you.
Yeah, actually, that sounds great. Now, let me ask you this, because and it's been a minute since I've actually purchased property, so you're gonna have to help me out. Now, I know that with an FHA, you will have, that mortgage insurance is already tied into that, and you have to pay like 80% down or something like that before it comes out. Are they doing the same thing? Is that basically the same thing that they do as far as the conventional loan is concerned? Do you have, once I pay, let's say I get a conventional loan, will, and that mortgage insurance company will come in there and say, okay, well, Carolyn don't have to do 20%, she can do 5%. At some point, will that drop off so that I'm good and I don't have to have that PMI in there?
It will. On a conventional loan, once you get to 78%, the system will automatically kick it off. And in the systems, they look at what you paid for it, and based off a schedule of how much you paid for it when you bought it. So it's just how the monthly payments goes down, and it may be 11 years. Let's say that 11 years. The other way you can get that mortgage insurance drop is as you're making payments, you're decreasing the balance there, but also what's happening at the same time as that balance is going down, the value is going up. Yeah. So what you want to do is, if the value has gone up and you've paid the mortgage down to 80%, all you have to do is call the bank and say, hey, I think I'm at 80%, so I want to see about removing my mortgage insurance. They will typically going to do an appraisal, which they're going to ask you to pay for. And then if that appraisal comes out and says, yes, you're at 80% or below, then you go back, they'll come back and say, yes, the value is there where you're at 80 or below. As long as you've been making your payments on time, then they'll remove it. So that's how conventional works. FHA has kind of changed their guidelines. They used to be the same way. Now they've gone to, if you get maximum financing, that FHA mortgage insurance you have for the life of the loan. It does not go away. Wow. So what we tend to tell customers, obviously, when you get to 80%, you're going to probably have to refinance into a conventional loan. That's if you use maximum financing. But if you put 10% down on a FHA, it is a way to be able to remove that. I think it's 11 years though. You got to have it. that it can be removed at that point. Still, again, FHA gets you in the house. Once you have repaired whatever you need to repair on your credit, you keep paying on time, then more than likely you're going to switch that loan over to a conventional loan. I always tell customers, when you purchase a house, you're marrying or fall in love with that house, you're not doing that for the mortgage. The mortgage is to get you in the door. When things change, you refinance. Typically, mortgages don't last but 7 years. When the rates really plummeted, they probably lasted 6 months to 12 months because everybody was so aggressively wanting to take advantage of a lower interest rate. So we're telling customers, obviously, the prices of houses have increased as mortgage rates also have increased. But once rates, so I'd say cap that house price now, because that house, once you buy it, it doesn't cost you more. You're not going to keep paying more for that house. But if you that mortgage rate drops once you've already capped that house, then guess what? That payment's going to go down. As once rates go down, you just refinance and you'll get a lower payment. But if you sit here and wait on the sidelines, like I tell people, you're just sitting there saying, okay, well, rates going to drop. Well, guess what? House price just kept going. So instead of paying $500,000, you're going to pay $600,000. Even though the rates drop by 2 points, your payment's not going to drop because you're paying more for it.
Right. Well, you know what? And that's a whole nother conversation. Because, and this is funny. I bought my first little starter home back in the early 90s, right? Mm-hmm. And I'm still having issues with the cost of housing now. I look at some houses and I'll be like, you want $400,000 for that? Yes. I just, it just amazes me how much these home values have just accelerated. And if you really want a nice townhome, which is what I consider a starter home now, you're paying $400,000, and I'm like, oh my God. And so it's funny because when my girlfriends go, when you moving? Never.
I say, I don't want to pay those prices.
No, I'm gonna paint a wall. I'm gonna throw up a little accent or something. Woo! And that's all I got to say about that. But let me ask you this, because this whole financial market is changing. We getting ready to have all these tariffs. It's gonna be, the question is, are we getting ready to go into a recession? Federal funding is changing.
Yes.
What do we do if I'm sitting on the fence about purchasing a home or changing or investing with this economic climate? What's your best financial advice?
I would still buy in this market because housing prices may come down. I just wouldn't max out. I tell people, be responsible. Don't get 45 or 50% of your debts to income ratio when we qualify. When we qualify, you would say, okay, you can qualify for this house at the max at 50% of your income. Well, don't do that in this market. Go to 35%. So you're not maxed out. So you're able to save some monthly. Always put money back every month. Put money back. So you want to try to get to where you are financially, where you can at least 6 months put yourself afloat. And so that should be one of your goals. Reason I say don't max out right at this point, because we never know in a recession. If we hit a recession, your job may not still be there. We know as Americans and as African Americans, we're going to fight through and struggle. We're going to make it. You know what I mean? So we know how to scrap. I tell people, a lot of people are worried about what's going on. I think Black people are worried, but we know how to make things happen. We know how to make a peanut butter and jelly sandwich versus going out to eat in the streets. We know how to make a tuna fish to serve for people in the family. So we know how to do those things. So I say just buy now still, but don't max out. So allows you to still save, be prepared for those rainy days, and still be able to grab that financial wealth.
Look, I appreciate you saying that, because there have been plenty of nights I've had Fruit Loops for dinner, and I've been good with it.
That's right, exactly. I was gonna say, Black folks, we know how to handle things.
Yes, sir.
We just feel back.
Peanut butter and jelly is one of my most favorite meals. So look,
when you go today too.
So look, when you talk about, you said something that was really interesting. debt ratio.
Yes.
Can you really explain to us what that really means? What's a decent debt to income ratio? Because everybody, when I look at things, I want to save, I want to invest, I know I got to pay down debt, I want to do all of those extra little things.
Mm-hmm.
What is debt to ratio income? And when I'm looking at purchasing a home, what should that number look like?
Well, debt to income ratio is where we evaluate based off your income and your. What we tend to do is we look at your gross monthly income. So we don't go off a net. So we go off
Mhm.
your pre-tax income. And so based off of that, we will certain guidelines for certain programs will say, okay, we'll take 45% of your gross income, and that can go toward the house and all your existing debts. So that's your typical sweet pocket there is 45%.
Okay.
Some programs, the automated system now, if you have great credit, you have some reserves, it may take you to 50. Uh,
Mm.
I warn people on doing it, you know what I mean? Because we don't want the house. And most people think, oh, banks we don't want the house back. We want you to keep it and be a productive citizen and pay your bills.
Right.
So really, most programs want to stay around 45. Still, you got to think about it. That is
That's a lot.
45 based off of not take home income. And that's all debts. Now, some programs require you to be on your what they call your housing ratio, and that's what they evaluate what the proposed housing payment is based off of your monthly income. And those tend to be around 33 to 35%. If you buy a house and you're 33, 35%, and your debts all together about 45, I think you're fine. You know what I mean? You still have to be responsible, but I do warn people to go past 45. You have people pushing people say, oh, I want this dream house. Well, we can get it for you sometimes, but it
Mhm.
comes with a price because we are basing everything off of pre-tax income. You're not walking home with that money that we're saying. And
Right.
so you have to be weary of a lender that forces you, it does not tell you that you are putting yourself at risk at being at 50%. Now, it may be one of those, we do 50% because one of the spouses are not on the loan. Then
Mhm.
you have how other income coming in the house. Or if you work two jobs and we're only using one job, your ratio may be high. So then you are able to say, okay, you justify, I do have other income coming in. But if you only have that one source and you're at 50%, I really believe you're setting yourself up for financial strain. Because therefore, you think about that, you're not going to be able to enjoy life. You're not going to be able to enjoy the house. You're not going to be able to do things. So stay away from 50%. Even though we may say we'll do it, stay away from it. Is my
Right.
advice to our consumers.
Well, look, one of the things that I always say to a lot of my clients is that, if cash is king, then credit is queen. But one of the things that you mentioned was collateral. Now, I know cash can be collateral, but is there anything else that can be considered collateral that an individual could use when they're making a purchase, whether that's a first time home, dream home, or investment property?
Well, I mean, obviously, when we're saying collateral, when they're looking at that, they're looking at the house that you're purchasing. That is
Ah,
the number one thing that we're putting a secure lien on that house by saying this house is valued enough to be able to put this amount of money on it. And the way that we handle that is they're going to do an appraisal. The appraiser goes out there and try to determine the value, the marketability of that house. And if we had to take it back from you as the consumer, we want to know that it's going to be worth enough for us to get our money back that we gave you. And so we ask for an appraiser to go out there and determine that value. Uh, Also, as a consumer, I would advise you to get a home inspection. Home inspectors go out there to determine, they don't care what the values were. They're going out there to determine if a good home inspector is going out to try to find out every little thing, small and minute, what is wrong with this house that could
mhm.
possibly set you up, as I said before earlier, that when you own the house, that's your house. You can't come to the bank to fix anything. You don't have a landlord. You are the landlord. And so you want to do a home inspection, whether it's new construction or whatever, do a home inspection because that allows you to be able to say, is this collateral worth my being able to sleep at night? So that's one thing when we're talking about collateral. There are programs out there, and I'm not that diverse in them, that you have money in a money market or large, you can use that as additional collateral. There are some that are out there, but we don't use those here, so I can't say to what the guidelines are, but there are capabilities of doing that.
Okay, look, one final question before we wrap this up. Now, let's say I want to do investment property, and it could be a duplex, triplex, or any of those kinds of things, or even just a commercial building. And I want to
Mhm.
do it with some friends. We want to go into this thing together. Do you guys do that kind of thing? And what's the best advice that you could give for a group of folk that are interested in collaborating and purchasing land, buildings or what have you?
You can do that all together. Obviously, we're going to evaluate you all to combine.
Mm-hmm.
Being able to say, okay, all of you guys, can you handle this debt? And we're going to bring all your income together, bring all your debts in there, and kind of say, okay, does the ratios work on you qualifying? The advantages of buying rental property is if we're able to count some of that rental income that you're going to get for the rent. We'll
Mm-hmm.
take 75% of that, and it can offset the mortgage payment. You can't get that as additional income, but you can use it to offset the payment. So if we said the payment is 1,500 and 75% of whatever you're going to rent it for ended up being 1,500, then offset it. So
Right.
therefore, your debt to income ratio is not affected by that. So that's one way to do it. So it is good you can collaborate together, but you just have to be a like mind. Does it make financial sense for
Mm-hmm.
us each to get $50 or $100 on this as profit, net rent profit? I always tell my renters, the people that, as far as my people that buy investment property, you need to save a large percentage of whatever they pay you in rent and put it in a rent account. Don't
Right.
use that for anything other than that property, because
Mm-hmm.
eventually they're going to come to you and say, landlord, the water heater broke. But instead of coming out of your personal funds, you can take it out of that fund. So
Right.
don't commingle your money that you get from your rental properties. Keep that in a separate account. So that allow you to always and then the bills that are associated when tax time come as well, to be able to write those off as repairs with that specific house. It's much easier, and your accountant was going to love you probably for doing it that way. Uh, but that would be my thing, is that you there are ways for you to do it. Now, on an investment purchase, typically you're going to require you to put 20% down. Um, if you put 25% down, you get a better rate. So I tell customers, sometimes giving that a little extra, and it could be a difference between 0.5% to 0.75% in rate. So sometimes if you have the cash, put it
Mm-hmm.
down, because it's going to save you in interest over that time period, to be able to put that little extra 5% more.
Ooh, Brian, you have given us so much good information today. We really do appreciate it. Now, here's my question to you. You got, and I love my young people, and we want to always impart words of wisdom to you. What would be some of the best advice that you could give a young person? They're just starting out. They're looking at this debt management. I want to be retired at 50. What is the best advice that you can give someone that is coming out of college, or they're in their trade or what have you? They're starting out and they wanting to do good things with their money. What's the best advice you could give that individual?
Buy a property as soon as you can, and buy a small property, meaning buy a townhome, or buy, the better yet, if you can get a duplex, buy a duplex. The reason I say that is because you're going to say you're going to live on one side of it and rent the other out. And so therefore that rental on that side help pays that mortgage payment. Sometimes it offsets it all together. So therefore you can just save your money monthly. And then guess what? In a year, 2 years, 3 years, how it is, then you move out of that other side, rent it, buy another primary residence. Then you have two sources of real income. Keep
Right.
buying while you're young. Buy 2 or 3 duplexes as you kind of keep going through the process. That is the way to create wealth. You want to try to get to 7 to 10 rental properties. By the time you're old, guess what? Those things will be paid off, and those are going to cash flow. Guess what? You don't have to worry about the market. People got to live, so they're going to pay. You obviously going to get that rent. There's several wealthy people that do that. I'm just collecting, $30,000 a month in rent. I don't worry about my Social Security. I don't worry about my pension. You know what I mean? And also, if you have kids, you can leave that into generational wealth. You can will those to your kids and allow them to also start doing the same thing. because land is always going to be there. Properties are always going to be there. Bitcoin and those type of things are fads. I would say jump in the market as soon as you're able to, and don't be afraid. Start small. Don't try to buy that dream house first. Buy the townhome, buy the duplex, and that's where I would say.
I love it. Brian, thank you so much. You have given us so much to digest and absorb and put into really good practice. And we want to thank you so much for your time today. Now, folks, you want to remember that financial freedom, it isn't a dream, it's a decision. Stay strong, stay focused, and stay fortified. Until next time, like, share, and subscribe. We'll see you soon. Thanks.
Thank you.